Hey, everybody, welcome back to Grain Markets and Other Stuff. Thank you for joining me. I'm joined by my friend Chris Barron today from AgView Solutions. Chris helps farmers out with farm budgets and a lot of other stuff. We're going to talk about farm budgets for 2022 in particular and how they compare to this year. Chris, what's going on in Iowa?
It's dry. We need some water. So apparently the market thought we were going to get some water and got a little hard on us for a little bit there, but maybe they're starting to have second guesses here.
Yeah, these weather forecasts and models continue to fluctuate. So the deal here today, guys, is that we've got some good prices for the 22 crops, like your D's 22 corn, your November 22 beans, but you're also going to be dealing, I believe, and Chris is going to talk about this, with some higher input costs. And the deal here today is that we want to start to get a feel for 2022, how it compares to 2021, and kind of what we can expect. So, given that, do you want to start with 21, Chris, and how you kind of think that it's imperative to know those numbers first before you start with another year?
Yeah, right, Joe. It is. This is the time of year when operations are getting kind of wrapped up between the replants and the spraying and chasing your tail pretty hard, hot and heavy here. I think it's time that we maybe sit down here and just recalibrate our cost of production on the 21 first. So we'll get to
Mm-hmm.
the 22, but I think, some things change during the course of the year with, you do your settlements on your seed orders and you get done with crop protection and, there's still some things going on yet, some more nitrogen and maybe some fungicide and things like that later. But there are a lot of things that are absolute knowns now. And so let's get those things dialed in because inaccuracies in some of those line items can really skew our cost of production. And so what I have so far right now is just kind of an average. And so what we'll go through today will be more of some average numbers, but I really implore everybody to just take that couple of hours, sit down, go through a couple of your invoices and dial these numbers in, recalibrate that cost of production because it's pretty important when we've got these price opportunities and with this volatility, there seems like there's an opportunity about every couple of weeks that we probably should be taking advantage of.
Okay, so do you want me to go ahead and throw your 21 sheet up on the screen here?
Yeah, let's put that up and we'll start
Okay,
talking. So you can ask some questions as
sure.
you fit.
Well, why don't you start with what you're seeing here in regard to 21? What's maybe changed since like that pre-planting to planting period? I mean, anything along those lines?
Yeah. So, like I said, what we're looking at right now are averages of our clients, and so our average client acres on the corn's right around that 2,200 acre range. So we've got operations with a couple hundred acres of corn and operations with significantly more than that. But what we do is we essentially take our profit manager numbers and we essentially just average them so we can kind of get a pulse on what our client base is looking like. We've got the corn yield right at 200. Our extra average that came in was like 201. I just plugged 200 in here though to do a comparison with 22 here in a second. But if you can see this, Joe, we've got I basically what I did as of this recording is I just went in and plugged in the D21 price. Now I know a lot of people have sales, and we've got a lot of people that are sold in that mid $4 range right now with a percentage of their crop sold, and yet a lot of sales to make. And so I think it's important that we plug in where we're at on that price and kind of look at what the opportunity presents, in terms of a margin based on your expenses, wherever those price opportunities are. And so what we're seeing though on the expense side as far as changes significantly really is the nitrogen and fertilizer. Those two categories bumped up some from where we were a few months ago, and we've got some more to get in. So I don't have all of the data in. So I think those numbers are going to actually increase a little bit more yet because not everybody had all of their fertilizer, their nitrogen, and some of those crop inputs like crop protection. They're spraying. We're seeing operations that had really dry conditions or really wet conditions and have had to do some resprays, replanting. and all that. And so some of those things have actually increased the cost of production. I don't exactly know how much yet, but I would anticipate we're going to see, another 15 to $25 an acre increase pretty easily,
That's pretty
probably.
substantial.
Yeah, it's going to be quite a bit, I think, on average. Some operations not as much as others, but you can also look at this equipment. If you're out replanting and respraying and doing some of those things. The other one that I would keep an eye on too is that drying expense. Right now, we're at about 8 cents on average. That usually ends up being close to around 12 cents. I'm not sure why our average is a little lower than normal, other than we got planted early in a lot of areas, and so people are anticipating a little lower dryer cost if the crop matures sooner, and anticipating some drier weather, which it's hard to predict weather 3 days out, let alone 3 months. So I'm anticipating that drying cost is going to go up. I know as far as LP, and those who need to be booking that, I think we need to be watching that really close, and maybe getting some of that feathered into to more of a known expense, especially when these corn prices are as high as they are. I don't think it's too bad of an idea to start getting some of that stuff bought. And some operations already have that locked in. So that's kind of where we're at on 21. Any other questions? I mean, when we look at our average, you can look at this ROI, and if you're not watching this and you're listening, if we saw an average market price of that 475, 478 range, that's over a 40% return on investment, because we're looking at a cost of production on average of about 390. Like I
That was
said,
with
Joe,
a five. That was with a 570s. You're talking, right?
yeah,
You
that's in the
said four.
five.
I assumed you misspoke there. Just making sure.
Yep, yep, yep. In the 570s there. I'm thinking four something because that's more normal. But yeah, that 570 something price, or 550 price, is giving us a return in the 21 like we have not seen since probably 2012,
Yeah, so
2013.
that was going to be one of my questions. Was historically you've got a 48% ROI punched in there at current levels with these average numbers. I mean, is that the best you've ever seen? Is it close to the best?
The 2012 is about the best I saw, even in areas where the yields weren't very good, because the insurance indemnity was pretty high,
Right.
and so we could see that again. And we don't
What
start
sort of
messing.
levels? What sort of levels did you see in that year?
We saw anywhere from, on the low end, probably in the 20 range.
Mm-hmm.
On the high end, we had some that were up around, 60%. It was crazy, crazy high levels for some operations, and there were operations that didn't sell grain because they were super dry and it didn't know if they were going to have the yield. Ended up having decent yields in some areas, so they kind of double dipped. There was insurance indemnity, and they didn't have a lot as much of the grain sold as they produced more than they thought they would. And I think that's a concern right now. It's really hard to put a floor in, or in other words, to sell cash grain when it looks like, am I even going to produce this? I mean, I just talked to a client in North Dakota a couple of days ago. He's replanting about 2/3 of his acres. He was super dry. He had a freeze. He lost about a third of his acres to a freeze. He was replanting that, and then 2 days later they got 5.5 inches of rain, and it washed a bunch out, and he got hail along with it. So he was replanting another third of his acres. And so, when that stuff's going on, it makes it very hard to make sales to any percentage that's really meaningful, when you're these production side of things is a little bit unknown. So I
Yeah, and of
get
course
that.
the market always gives you some of the best opportunities when you just have no idea. That's part of the problem,
Exactly.
of course. That's why grain marketing can be so hard, especially this time of year.
Yeah, and that's a lot of times exactly when you need to be pulling the trigger on some stuff
Hmm.
here. And again, why it's so important, I think, to have these numbers locked in. And that's about all I've got on the 21 before we go to 22. Is there
Let me
anything
ask you
else?
one question here. So you've got just given current market prices for corn, you've got on average a 48% ROI. You said there were numbers better than that in 2012. What had that ROI number been running kind of in those dog days from 2015 through like 2019? Was it back and
Uh,
forth between break even? I mean,
Yeah, I mean, we saw most of our clients at the end of the year would be in the black, but it was so scary in the beginning. You almost didn't even want to run any estimates or look at a cost of production because the numbers at the beginning of the year from about 2014 through 2020 at the beginning of the year were red, and
right.
so but there were opportunities almost every single year at a certain point during the year to plug those sales in, and then usually there was enough yield. I mean, we yielded our way out of a potential catastrophe a number of those years where
Hmm.
the bushels lowered our cost of production significantly enough that we at least at a minimum broke even in most every case, and then had profitability levels anywhere from that 3 to 8 or 9%. But when you're sitting here looking at really this is probably a gift horse, when you see these price levels where they're at, and obviously there's volatility, it gets the emotions going, but these profitable levels that are here right now for 21, I think it's pretty hard not to take advantage of that to a degree.
Okay, well, tell me how it compares to 22. So for 21, you're looking at current market prices with your average customer base at a 48% ROI on that's on corn, right?
Yeah,
Or is
yeah.
okay? So go to 22 and tell me what's different or what looks different as of right
Yeah.
now.
So what we've done is we have a side by side tool here, and we'd offer this to any of our clients who have um, profit manager. You just email a Barron at AgViewSolutions.com. That's my wife Alyssa, and she'd send this out to you if you've already got profit manager. If you don't, um, basically we're just going to charge $25 and you can get the tool, and we'll send it right out to you. Just email us that you want the tool. And like I said, if you got Profit Manager, we'll just get it out to you right away. But what we're trying to do here is with 22 is look at it as a percent of increase or decrease. It's probably not going to be a decrease when we look at what inflation's doing right now. But what we're doing is we're going in, and if you can't see this, and if you are looking at it, you see in the green, what we do is these are the input scenarios. So again, obviously, as we said, start out with 21, plug in your cost numbers so you can get your cost production calibrated correctly or as close as you can for 21. Then the 22, then you basically just go in and adjust your percentage for each of these categories. So for example, let's just take return to management. Our definition of return to management is all of your farm's overhead expenses. And so what that includes is like healthcare, kids in college, any expenses that have to come out of that crop enterprise to, owner draws, any of those overhead expenses, fuel, utilities, that kind of thing. So what we saw and what we see is I went back and looked at the 2012 time frame, and it was interesting from 2011 through about 2013, we saw a pretty significant increase in return to management cost and a per acre basis. And we saw it go up anywhere from about $5 to $10, depending on the operation per acre. And that was due to two different things. Number one, there was some inflation at that time in terms of crop inputs. So the crop input costs were going up, nitrogen was going up, fertilizer, and some other things. But that correlates to, your fuel is more expensive. Some of those things cost more. And what other thing that happens is when we all make more money, guess what we do? We spend more money. And so there's a direct correlation, and I can go back and show you every single time that we see the market price go up, we all spend a little bit more money. And right now what's going on is we have this inflationary component. I mean, a steak's twice the twice the cost now that it was a year ago. A lot of these things are more money. So we have a 9% in there right now, and that correlates to about a $5 per acre price increase, as you can see here. And then, what we look at is, okay, what is that in terms of a cost per bushel? Well, with 200 bushel corn, that's 2 cents. So it really doesn't seem like that much, so maybe it is, maybe you are going to spend more. Maybe you need to plug in 15% in there or whatever it is. And so the nice thing of it is you can go in there and you can plug a different number in there. 15% on 200 bushel corn is 4 cents, or it's, $8 an acre. And so you can go in and look at these individual prices and get things correlated and estimated to the best of your ability, and then it shows you what your bottom line is, which is really, I think, a key component to understanding where you're at with your operation. Same thing with land. As we start having conversations with landowners, I guarantee everybody's thinking about this already. July and August is when we start having those conversations and get them, a lot of them finalized by September. And what are land costs going to go up? I don't know. I'm at 6% right now, which is about $15 an acre on average on the rental ground. A high percentage of this in this database is average, again, and a high percentage of it is rented ground. And so, what's yours going to go up? I mean, it's lower for some of the clients we have that own more of their land. Their land cost is a pretty static number. So maybe theirs is only 2 or 3%. So that's why this is very individualistic, where and why it's so critical that you plug your numbers in. I mean, I can show you these averages, but you need to sit down and plug these in for yourself, because you can be off 5 or 8% on the bottom line and not pull the trigger, or not pull the trigger on enough because you're just unsure of what that profit margin potential really is. And so I think it's pretty critical. When we look at fertilizer, you can go down there and look at fertilizer nitrogen. On average, we're at about a 38% increase on P and K and some of the micronutrients and stuff. And some of that stuff you can't even get right now. Nitrogen, about a 35% increase. Probably it's going to be more than that. Those are averages and estimates that I've got from clients and what they're getting for information as far as what they're going to be paying. So, I mean, we're looking at fertilizer going up, 15 to $16 an acre, or nitrogen maybe another, 25 to $27 an acre. That means your nitrogen cost on 200 bushel corn is 14 cents a bushel higher.
Mm-hmm.
And if you look off to the side here, if you are watching this, you can see I have cash flow impact there too. So, and maybe you'll have one or the two of these that actually are lower, which would be nice. Probably not likely going into 2022, but you want to know what the cash flow impact is. And so, like on our average that we have here, we see about, and I'm going to bring this back to that 9%, we see about $172,000 cash flow increase going into 22 for our clients on average. Again, it's so important that you look at this on your own. What's your cash flow requirement increase for 2022 if your inputs are in fact going to go up? I mean, there's no better time to start analyzing that than now, and then you can adjust this as things go along, because we are dealing on the markets, we're dealing with the futures, right, Joe? I mean, and so if we don't, sort of put that line of what our estimated costs and prices are out into the future, so that we can make some of these decisions and start to step into the market a little bit, it makes it difficult to make decisions unless you've got this stuff in front of you. The other thing I would say too is, if you look at this, you can see right now at $5 corn, that's about $150 an acre for our clients on average, even with a price increase of about 40 cents a bushel on 200 bushel corn, we're seeing still $150 an acre margin. So, I'm not I'll leave the market advising to you, Joe, but what I would say is that, we can plug our own numbers in, and then we can start to make, executive level decisions for our business of what margin target do we have and what's sufficient for our business to either stay in business or to be more profitable. And, when we look at the opportunity right now, as we speak and record this, there's about an 18% ROI on average for our average clients, which tells me, that's an average, which means there's probably hardly anybody that's going to lose money, depending on where their expenses are. But it just looks like there's pretty good opportunities here.
So just to compare it, in this particular example, your ROI for 2021, you've got penciled at 48% on average. That's going to drop down to 18% in 2022, given what we know right now, because you've got a corn futures price that's a good, what, 70 cents cheaper for 22, plus you've got higher input costs. So it's kind of like a double-edged sword there.
Right. And if you go in there and plug in 450 though on the 21, you don't know what these prices are going to do,
Right.
right? And a lot of these guys sold corn along the way. I mean,
Right.
every time the market goes up and you look back at those sales you made, you're like, well, why did I do that? Well, because you're a risk manager. And if a person right now is sitting there with an average selling price of 450, and I can show you a bunch of operations, probably mine's not that far off from there, at 450, and we still maybe have 60% of our crop to sell yet, that's a 15% return on investment, or $120 an acre. And right now we're looking at 2022 at 508. You can start making sales at significantly higher levels than we started making sales in 2021. And again, I'm not making advice at all here. I'm just pointing out the obvious that, these price levels for starting marketing are significantly higher than where we were able to start for 2021. Even though these input costs are higher, we're high enough higher for the 21 to kind of justify a lot of these operations to really take a close look at this and to make some decisions.
I want to ask you another question about historicals. So I know you've been doing these spreadsheets and this sort of work for a long time. With an 18% ROI penciled in for 2022, how does that fare relative to, say, the last 20 years on average? I mean, would that be considered good still?
That's good, yeah. Because and let me preface this. Let me explain this too, because there are different ways to look at this. The way we look at cost of production at AgView Solutions is part of our cost of production is paying ourselves. So our profit is baked into that already too. Okay, so we don't look at this. A lot of universities, how they'll analyze things, they'll say, okay, well, like I just showed you on the 2021, a cost of production of 390. I'm showing you 2022, a cost of production of 429. Okay, so that 429 cost of production projection for 22 is we're sitting here looking at $128,000 of that operation is all overhead expenses. Well, a university is not going to take that cost into account. But the way we look at it is, as a business, we're not going to do this for free. We want to make money, right?
Right.
And so part of our cost production is paying ourselves, is paying our employees. It's, sometimes we accidentally buy a boat or whatever it is, we got to pay for that stuff that we purchase. And so we want that to be in our expense categories so that when we pull the trigger, we know we're pulling a trigger at a price, at a profit level that keeps us in business in a profitable manner, not just break.
Right, I gotcha. Yeah, that seems to be a little bit more like that seems to be a better real world application, I think.
Yeah, and it makes us feel good to say, well, my cost of production is 350. Well, if your cost of production is 350, but you don't have all your overhead costs in there, and your overhead costs are 50 cents a bushel, you're going to start selling grain at too low of a level, or you're going to be too aggressive, or you maybe won't be using some of the tools that you should be using to manage risk. So those are some of the concerns that I see, and some of the advantages we see when we're working with clients, and to realize that their cost of production is probably maybe a little higher than they think it is, but that's okay to know, because then it allows you to have the courage to pull the trigger when you need to, with respect to managing profitability and managing those margins.
Chris, I think this is a pretty darn good start to 2022. If somebody is interested in talking to you about AgView Solutions, or about the work that you're doing, or how you might help them, what is the best way to get a hold of you?
Yeah, probably the best way is just to email us, Barron at agviewsolutions.com or Barron at agviewsolutions.com, and then just reach out to us. And Shay Folk also works with us, does a great job. We do a lot with machinery and equipment management and those kind of things too, and helping you to dial in some of these individual line items, and if people have questions, or if they take just this tool and want to call us, we'll work with you, talk through things, and help you kind of think through how do we get these numbers more accurate, because the tool is one thing. The tool is only worth what you put in it. And so, if you're not going to sit down and really get these numbers dialed in, I wouldn't even, it's hard to say, yeah, go ahead and do this, because you want to get these numbers dialed in to the best of your ability. One other thing, Joe, real quick on the soybean side, if it's all right. I just want to mention, this also is set up for soybeans as well. And so we've got pretty much the similar percentages of cost increases and things there too. And so we're looking at about a 28% return on soybeans right now. In the 22 on average, we're looking at about an 8% rate of return. And that just is a function of where the price and where the yield is that guys have in there. We've only got 57 bushel in there for soybeans. I think you almost, when you're looking at 200 bushel corn, if you were to compare apples to apples, you about need 60 bushel beans. And our client base has a little bit lower number in there currently, so in their forecast. So, but I just wanted to point that out, that we've got soybeans to kind of do the same thing, and we can do it with wheat and other crops as well.
Great. Well, thanks, Chris. We'll have to do an update on this, a few months down the road and see how things have changed and
Yep.
progressed with market fluctuations and input cost fluctuations. But I think this is a really good start. Guys, that's Chris Barron from AgView Solutions. If you have any questions, you've got his email, and I can get you in touch with him too if you reply to the YouTube video or send me an email to info@standardgrain.com. Chris, thank you, buddy. We'll talk to you later.
Yeah. Thanks a lot.